You say, well, Toni, look what happened here. Johnson & Johnson in the beginning part of 2004 moved up over that 30-week moving average you're talking about. I bought the stock, but then it jumped up and rolled back over and fell through that moving average. Yes, but you put in your stop loss. You put in your protective stop at 7% of $52. Your stop is at $48. You're totally protected. Johnson & Johnson didn't retreat to that price point. It rolled over and started right back up again. You were totally protected. Had you not even looked at the stock to see how it was doing, you would have been okay. Johnson & Johnson kept moving up again until March and April of 2005. It did start pulling back. When it fell through its 30-day moving average in May of 2005 and made 2 consecutive closes below that moving average, you would have sold the stock using this criteria. You would have bought at 52 and sold at 65. That's a pretty good percentage profit to make, and a safe one. Above all, remember, we want to preserve our capital. We want to preserve our profits. Okay, now as we're looking at this chart, and I picked this chart on purpose because, believe me, the stock market does not behave. It does not act the way we want it to, and certainly the stocks that make up the stock market sometimes act like a bunch of irrational teenagers. They are all over the map. What we don't want to do is look up one morning and find out that we've lost $10 or 10 points in a stock. We don't want that to happen. In this particular scenario, Johnson & Johnson, when it moved up past that 30-week moving average back in the beginning of 2004 and we bought it, it could have very definitely risen up higher and then pulled back and dropped to our automatic protective stop loss at 48. We have to learn to do one thing with our shoulders. We have to learn to shrug. We have our insurance, and this is the stock market, people. It's getting more and more volatile every day. And if we get taken out of a stock for the price of a few dollars plus a commission, aren't we far more fortunate than if we hadn't paid attention, hadn't placed a stop loss, and had let the thing fall further and further down, and in essence lost a lot more money, and then had to hang on to it and hope we'd made it up. I know all of us, myself included, have bought stocks, invested in stocks, ridden them up to big profits, thought we were rocket scientists, and then paid no attention, and in our euphoria let these stocks move all the way back down to where in fact we end up taking a loss. Please believe me, when you're investing in the market, especially as volatile as they are today, especially with the global events we have coming in that are unexpected every moment in time, it's totally necessary to put in our insurance, to put in our protective stop orders. Yes, you are going to sometimes get out with a small loss. Sometimes those stops are going to be hit sooner than you thought they were going to be. But if you think back, your first loss is always your smallest. Is always your smallest. Think back to companies, think back to people, and hopefully it's not you, who invested in Enron, who invested in MCI WorldCom when it was having problems, who invested in other kinds of companies that have done the same thing. How wise they had been, how wise would have they been if they put their protective, their insurance stop in, and then raised it a couple of times during the course of the stock moving up. How smart would have that been? There would have been far less losses than the trillions and trillions of dollars that were lost on those particular investments. So put your insurance in, and know that while you may get stopped out once in a while, you're going to be very thankful and very grateful that you've done it many, many times over. Let's look at this particular price chart and see where we could have raised our stop loss points to a couple of times to ensure that we made really good profits. If you can draw a horizontal line, and I bet you can see that the price found what we call support right in the $54 area, right where the bottoms of all those bars are throughout the second half, or right about the middle of 2004. Just draw a horizontal line with your eyes or a pencil, whatever you like. You can see how we're doing it here. And you can see that every time Johnson & Johnson fell down to a particular place, it always stopped right there at that $54 area. A smart thing to do is move your protective stop up to about $1 or so underneath that particular area. So where would we raise it to? We would raise our protective stop to about $53, $52 if you're more comfortable, as soon as one or two of those support areas were formed. This tells you that when this stock keeps coming down to this area, buyers come in, say this is a good price for Johnson & Johnson, and in their buying they hold it up or they support it, and eventually it begins to go higher. Now what were to happen there? If you raised your stop and the stock, as we say, rolled over and went through it, well, the very worst thing that can happen is you make $4 a share profit. That's not too bad, and it's a relatively short time period. When Johnson & Johnson starts back up, if indeed it does, and it did in this case very definitely, you can reinvest if you'd like. At the worst case scenario, you've made money, and that's not a bad thing in this day and age. What the other thing you've done is something we're going to talk about more in a few minutes. You've protected your asset known as your portfolio. You've protected your equity, and that is the single most important thing you can do in your investment career. Now, Johnson & Johnson moved up for the latter half of 2004 very, very quickly and very, very nicely. When you get more advanced and you become more advanced, you can start drawing trend lines from the bottoms of each of these moves up. And perhaps you want to use these trend lines as your stop area if you want it to get tighter and tighter. However, if you don't, know that many times the 30-week moving average will form a trend line of its own. And we know that we're not going to keep the stock if it makes one or two closes below that moving average. So that in itself is your automatic stop out. Again, Johnson & Johnson fell below our moving average in June or July, it looks like, of 2005, and we've made quite a nice profit. Let's move on to our next chart. Here we have a chart of Alcoa Aluminum, the huge manufacturer. We have another example of how we could have bought Alcoa Aluminum when it rose over. Please keep this word rising in mind. I said it over and over, but it's so important that the 30-week moving average is going in a horizontal direction or at least rising. We never, never, never buy when a stock is moving over a falling 30-week moving average. Now, a moving average is just that. It's the average price of a stock over a given time period plotted into a line form. Here's another clue, and something I wanted you to see on this chart. When we're investing in this kind of a way, when we're looking at price charts in this kind of venue, what we're doing here is something you're going to want to study more, is we are buying stocks that have come down in the roller. Remember I told you everything goes in cycles? Well, so do these big icons of American industry, so do their prices. These stocks have moved up in value, come down in what we call a downtrend, stabled off in the trough or the base of the cycle, and started moving up. What we're doing is we're buying stocks when they start moving up. We're trying to get the biggest reward for the smallest amount of risk. And that's why I'm using this particular indicator. That's why I'm using price charts for my investment. Once you look at price charts, very, very simple ones like these, and study them a little bit, your eyes will get trained and you're going to start to see how they relate. So, such valuable information for you. Pretty soon when somebody says, would you like to invest in something, the first words out of your mouth are going to be the first words that are out of mine. Let me look at the chart. Now again, and when you combine that with the fundamental information and the other information that you've kept track of, that you've looked at, you're going to find it to be a very, very, very valuable analysis tool. This is a weekly chart of Alcoa Aluminum, a bar chart, just like our last one with Johnson & Johnson. And again, you can see how we use the 30-week moving average as an indicator and a decision support tool. Now, as you can see on this price chart, Alcoa aluminum came all the way down in the middle of 2002, kind of touched off here at $18, moved back up, retested almost, but not quite that, and moved up again over our 30-week moving average. As it moved over this moving average, and this moving average here is rising slightly, we bought Alcoa aluminum at about $23. Immediately, we put our stop loss in at our 7 to 8% point of $21.30. Now we've got that insurance in. Now we know that if anything happens to Alcoa aluminum, it doesn't have far to fall before we're taken out. Notice how we bought Alcoa aluminum at 23 and it ran up to about 26, and then it had to rest for a little while. And as it was resting, buyers came in, increased demand, and moved it up even higher in price. Price charts are human emotions in a picture. They are human emotions. At the bottom of this price chart back in the year 2002, we can see fear. We can see panic. Probably people who had this stock panicked when it moved in a downtrend all the way down. Then as it started up in 2003, you can see little bits of optimism coming into the market. Some people are starting to nibble and say maybe the stock is going to move higher. The optimism will move more and more into greed, different levels of greed. When you see a stock go from here to here, now we're talking about the emotion called euphoria. When you see a stock move in a almost vertically in an uptrend and change the angle the way Alcoa aluminum did, now you want to start raising your stop, if you know how to read this kind of trend, in order to get the maximum profits. And if you don't, it's okay. If you don't, you can wait until it crosses that 200-week moving average line, as Alcoa aluminum did in April of 2004. It crossed over this line, made certainly 2 consecutive closes. We could have gotten out here easily at 34. But remember, I keep using the word close. It did not close below that moving average, and the close is the most important part of the day or the week for any stock. The close is when the commitment's made. The close is when people say, okay, I believe enough in this stock, I believe enough in this company that I'm going to hold it overnight. And after all, time is a premium in any of these investments. The longer you're in an investment, as simply put, the more things that can happen. So let's keep that closing price in mind, especially on these weekly charts. That's a really good information guideline. We bought at 23, got out at 34, and our time frame was just a matter of a few months. Do you see how these moving averages can keep you safe? Do you see how using a criteria, this one or one similar to it, can keep you from taking big losses in the market? Now, stocks will sometimes go like this. There's nothing we can do about it. But whatever you do, always use a criteria to enter the market. Don't just do it helter-skelter. In this day and age, it's not the wisest thing to do. Alcoa aluminum moved up higher and higher. Again, it made little pullbacks. You can move your stop up underneath the support areas you can see all along this trend line. Now I want to tell you something about trends. Now that you're getting used to looking at charts, look at Alcoa aluminum and look at how steeply it rose between October of 2003 to the end of the year. Notice how it was moving kind of at a 45, well, a little steeper, 50, 60 degree angle. Now just simply look at how that trend changed from October on. Notice how it started to go up ballistically, like a missile. What happens to things that go straight up? Anything in our world, usually at some point comes down pretty hard, right? I want you to look at the final point here I'd like to make about Alcoa aluminum. We know we got out at the price of 34 back in February, March. Notice how Alcoa aluminum pulled back from that area to about 29, did a few gyrations, and right around October, Alcoa moved down. Alcoa moved down, not ever touching our rising 30-week moving average. And you know what? You could have raised your stop up right here. You could have raised your stop up to about the $25 area, kept it right under here, and now you would have made a $2 per share profit in every share of Alcoa aluminum that you bought. Now let's look at Boeing. This is our final chart, and it's a very beautiful chart, I'm sure. This is a chart that makes every investor happy, especially as savvy investors like we are, because we knew to buy in 2003, and we knew to buy and get in at 31. That's where our price crosses up and over our 30-week moving average. I think it's wise to watch these stocks. I like to catch them before they move through the average, so I can watch and see and get in at the highest precision point. Boeing moved up and over. Now the moving average isn't moving down here when we enter. It's moving sideways, and that's totally acceptable. On this particular example, we would have bought Boeing at $31. Immediately we put our stop loss in at $29. That's our insurance in case it goes lower, and we're not ever going to move it down. We're only going to move it up as the stock goes higher. Boeing retraced a tiny bit back to almost to our entry price, and it took off from there. We can move our stop up several times on this chart. Now notice, you might have been bumped out of Boeing here in March and April of 2004. You may have decided to take profits there. If you have a question about whether you should get out when it's so close, when it's such a close call as this one, always look left on your chart and see if there's buying support just to the left. If there is, you maybe want to hold that price just a tiny bit. That's for more advanced investors. In January of 2005, you could have gotten bumped out of the stock again. It's quite possible. Now, what will you do? What will you do? My advice is, if you do stop out of the stock, if you do decide to sell it, if it does go down, watch it. And if you think the stock is still worth being in, if it moves back up over its rising 30-week moving average, you know what? They'll let you buy it back. I called my broker the other day. I said, Fred, if I sell a stock and it starts going up again, can I buy it back? And he said, Toni, anytime you want. So for the price of some commissions, for $20 or $30 or $40 commission, you can do that. But don't you have more peace of mind knowing that you've got your insurance in, that you've got your criteria set, you've got your rules, you've got your guidelines, no matter what. You can certainly buy it back. Suffice to say, Boeing started it up again, and you know what? It's still going at this very minute. I can't tell you where we're going to get out on this one. We're in at 31. The stock has doubled. I don't know where it's going to roll over and come down. We do know one thing, though, don't we? We're definitely going to take our profits when this stock rolls over and makes one or two closes below our 30-week moving average. For right now, though, we're going to enjoy the ride. Let's say for fun that you moved your protective stop loss up just underneath what we call support areas, which are these little low areas. Every single time it stopped and started up again, those are the buyers we call support. You might be one of those buyers. You may decide to add to your position during those times. You may say, there are so many buyers in this area. There's so much demand for Boeing. And actually, doesn't the whole world, and indeed the financial markets, move on supply and demand? There's so much demand in this area, I'm going to add another 2 or 3 or 500 shares to my position. If you had not used the 30-week moving average here, but were just bringing your stop loss points up underneath, keeping them $1 or 2 underneath those support areas, that's another criteria that's valid, and you wouldn't have gotten stopped out of Boeing. You could have ridden it up, and kept going. If it did hit your stop in January, if you did decide to get out in January, you would have bought at 31. You would have taken profits at 50. I really don't see too much wrong with that. You'll never go broke taking a profit. In summary, when you invest, remember, always, always, always evaluate the current market environment. If you're 20 years old, it's okay to buy stocks at the very top of a bull market and wait through the bear market and wait for it to go back up again for the rest of your life. But the older you get, we don't have that time. We don't have that time premium. We don't want to wait and lose money before we make money. So please, look at the current market environment. Check all your resources. Check the financial networks. Check the newspapers. Check the financial section of your local newspaper. Kind of get a feel. Read what everybody has to say. And certainly you can figure out and you can pretty well target what the current market environment is and where you think it's going to go from there. Then focus down